Saving for retirement seems like a daunting prospect, but I'm joined on the line by Stephen Nathan. He's the CEO of 10X Investments. He's going to speak to us about the proper way to go about saving for retirement. Of course, this all comes on the back of the fact that Finance Minister Nhlanhla Nene has announced that soon South Africans will see the first draft of regulations that are looking to really strictly regulate some retirement fund products in the country. Stephen, when you speak to people my age and a bit younger who are just entering the workplace, the idea of putting away a significant portion of our income into this retirement thing that I'm only ever going to use in 40 years' time, it seems ridiculous, really, to many people. But I think you would probably disagree with that sentiment.
Yes, it seems ridiculous because by nature we are much more focused on the present than the future. So there's lots of psychological studies that have been done that say that we people are very bad at making long-term decisions. We're not programmed. It's not in our DNA. We're not trained to do that. And more and more we seek instant gratification. And one could argue with technology and instant messaging and social media that we're caring less about the future and more about the present. So it certainly doesn't come naturally to us. And by definition, savings is delayed gratification. So it's, we've seen these studies with a young child and a marshmallow. If the young child doesn't eat the marshmallow now, then maybe in 10 minutes or 20 minutes, they're going to get 2 marshmallows. And although that's a very simple analogy to describe this issue, it's very true. And when it comes to saving for our retirement, unfortunately, if you look in South Africa and all around the world, is that governments aren't providing for people's retirement. And those governments that have got in a lot of financial difficulty and actually having to renege on some of those promises. So it's up to us. And if we don't do it, we can't rely on the state. And when it comes to investing, one of the most important principles is what we call compounding. It's that the longer you save, you earn a return on your return. And that has a snowball effect. And the longer you start, the earlier you start saving, the more that's going to work in your favor. And what people should understand is that time is your best friend as a long-term saver, because you can also ride out the short-term bumps in the stock market. So if you look at the chart of the stock market over time, almost in every 10-year period it goes up quite a lot, and certainly in a 30 and a 40-year it just goes up even more. But in the short run, you're going to get those dips. But if you start early, then you're giving yourself a chance to actually participate in the long-term growth, iron out the short-term bumps in the road that will always be there, and the compounding impact will be dramatic. And obviously, as an industry, it's up to us to try and communicate that a lot better to people your age and younger.
Now, Stephen, before I let you go, won't you speak to the viewer who's watching this who needs to choose a retirement fund product and is overwhelmed by all the various decisions they need to make and the varying products out there? How do you best choose a retirement fund product that suits your needs and the needs of your family?
Yes, it's a great question. So I think what you have to do is you have to take some responsibility, because frankly, if you don't take responsibility and you outsource that decision to a helper, now the chances are you're going to get a raw deal. Not always, but you're going to pay a high margin product and you're going to pay commission, and you're not really going to know whether you are in a good product. And sadly, most people end up in products that are not in their best interest. So the first point is do some homework, because the less you know, the more advantage you are going to be taken of. And the more you know, the more empowered you are, you're going to be able to make a better decision for yourself. Then once you do that, and there's so much excellent material available on the internet, and you can do a lot of this research for yourself by getting credible sources, not reading companies' marketing brochures. Investing at the end of the day, there's complexity kind of at the back end, but maybe it's like our smartphones or the iPad, where the front end is quite simple. And really, it all depends on your time horizon. And if you've got a time horizon of 5 years and longer, so I don't need the money now, I need it in 5 or 10 or 15 years, then what you want to do is you want to own a portfolio that has a high amount in shares or what we call equities. Why? Because when you invest in blue chip companies as a shareholder over long periods of time, you get a much better return than if you invest in the bank with bank deposits, or even if you lend the money to the government, what's called the government bond. But a lot of people, they're worried about the short term because they listen to the financial news and maybe Greece is exiting the euro and there's all this, seems this financial uncertainty. And once again, we focus on the short term and not the long term. So you want to really own a high equity portfolio. You must have other investments. We call that diversification. So you don't only own South African shares, you own global shares, you own some listed property, and you own bonds and cash. But you want the majority to be what we call growth assets, investments that are going to give you the high long-term return. Don't worry about the short-term volatility. And then you want to get that at the lowest cost. So you must be very cost conscious, and you must be very clear, what am I paying? What's my total cost of investing? And make sure that whoever is providing you that product explains all those costs, not just in percentages, because you might say, well, 3% sounds like nothing. But 3% will, if you pay that over 40 years, you will have less than half the money you should have. So these numbers mean something over the long run, and empower yourself so that you are taking charge of some of the decisions and you know what you are investing.
Stephen, you've certainly given us so much to think about today. Thank you so much for joining us.
My pleasure. Thank you.